yeah, we're coming in hot with another report pertaining to the CEO of Six Flags, Richard Zimmerman, leaving the company at the end of 2025. In today's report, we'll be taking a look at why Richard Zimmerman decided to step down as CEO at the end of the year. We'll also be looking at what does this mean for the stock prices and the company as a whole. Let's go ahead and follow along right here. Now, Six Flags CEO departure inquiry. Leadership transition at Six Flags, an analysis of Richard Zimmerman, departure and future outlook. Now, this is the executive summary. So Richard Zimmerman, president and CEO of Six Flags Entertainment Corporation, is stepping down by the end of 2025. This significant leadership transition was announced concurrently with the release of the company's disappointing second quarter 2025 financial results. The departure marks a critical juncture for Six Flags, which completed a major merger with Cedar Fair in July 2024, aiming to consolidate its position as North America's largest regional amusement park operator. Key aspects of this development include departure context. While officially framed as a planned succession, the timing of Zimmerman's departure aligns directly with substantial financial underperformance in quarter 2 2025, including, wait for it, a $100 million net loss and significant misses on revenue and attendance targets. This strong correlation suggests that the company's recent struggles are a primary underlying factor in the leadership change. So, financial headwinds. Six Flags attributed the Q2 decline largely to unfavorable weather and economic uncertainty, which led to a sharp stock drop of over 20% and a downward revision of a full year 2025 adjusted EBITDA projection. Now, merger integration complexities. Despite official statements acknowledging progress on synergy realization, the financial results and anecdotal did I say that right? I guess. Guest feedback indicate ongoing operational and integration challenges post-merger, particularly concerning consistency in guest experience and park operations across the newly combined portfolio. We've all seen that already. So, success plan. The board has initiated a global search for a new CEO, explicitly seeking a leader with a proven track record in operating at scale, defining and executing growth strategies driven by innovation, operational excellence, and world-class talent development. This highlights a clear mandate for a turnaround and accelerated value creation. Implications. The leadership transition introduces both uncertainty and opportunity. The incoming CEO will be tasked with accelerating synergy realization, improving guest experience, addressing the company's high debt levels, and restoring investor confidence amidst a challenging and complex operational and economic landscape. Introduction to Six Flags at a crossroads. Six Flags Entertainment Corporation, a prominent entity in the amusement park industry, is undergoing a significant leadership change with the announcement departure of the president and CEO, Richard Zimmerman. This transition occurs at a pivotal time for the company, less than a year after its transformative merger with Cedar Fair. Now, 101, context of Richard Zimmerman's tenure and the recent merger. Richard Zimmerman, a seasonal professional with 38 years of experience in the amusement park sector, served as president and CEO of Legacy Cedar Fair since 2018. His leadership role expanded to encompass the newly formed Six Flags Entertainment Corporation following its $8.2 billion merger with Cedar Fair in July of 24. This strategic combination was designed to establish the largest regional amusement park operation in North America, consolidating a portfolio of 42 parks across the United States, now Canada and Mexico. The overreaching goal of this merger was to harness complementary operating capabilities, broaden market reach, and unlock substantial value through the realization of synergy. Now, the merger initial promise and strategic rationale. The merger was initially projected to yield considerable financial advantages. These included anticipated annual synergies totaling $200 million, broken down into $120 million from administrative and operational cost savings expected within 2 years, and an additional $80 million in revenue uplift projected within 3 years of the transaction close. Furthermore, the combined entity was forecast to achieve a pro forma revenue of $3.4 billion and an adjusted EBITDA of $1.2 billion. The financial projection also indicated a pro forma leverage ratio of approximately 3.7x net debt to adjusted EBITDA, with an ambitious target of reducing this to a 3.1x within 2 years. Now, these figures painted a picture of a financially robust organization with enhanced flexibility of strategic investments in new attractions and improvements to guest experience. Disparity between merger promise and current reality. A notable divergence exists between the optimistic financial targets set during the merger announcement and the company's recent performance. The initial projection detailed a healthy pro forma adjusted EBITDA of $1.2 billion and a manageable leverage ratio of 3.6x. However, less than a year after the merger's completion, Six Flags reported a significant net loss of $100 million in the second quarter of 2025. Concurrently, the company substantially revised its full year 2025 adjusted EBITDA projection downwards to a range of $860 million to $910 million. This sharp contrast between the pre-merger expectations and the immediate post-merger expectations, our financial outcomes suggest that the anticipated benefits from either not materializing as rapidly or effectively as planned, or that unforeseen external factors have exerted a more profound impact than initially modeled. Now, this significant gap between expectation and reality likely served a critical element influencing the board's decision regarding leadership, indicating that the merger's value creation has been slower and more challenging than anticipated, potentially eroding investors' confidence in the current execution strategy. So, Richard Zimmerman's departure over official narrative and underlying factors. So, the announcement of Richard Zimmerman's impending departure of Six Flags was made in conjunction with the release of the company's second quarter of 2025, providing a crucial context for understanding the reasons behind the leadership change. So, the official statement on board's acknowledgement, Six Flags Entertainment Corporation formally announced that Richard Zimmerman would zippity-doo-dah, zippity-ay-ay, my oh my, what a wonderful day. Now I lost my place. There we are. Richard Zimmerman would step down as president and CEO by the end of 2025. To ensure a seamless transition and leadership continuity, he will continue to serve as interim CEO until a successor is appointed, and he will also retain his position as director on the company's board. Now, Silam Bassel, the executive chairman of the board, publicly conveyed gratitude for Zimmerman's leadership since the successful merger in July of 24, acknowledging his 38 years of unwavering passion and dedication to the industry. Bassel credited Zimmerman with successfully guiding Six Flags through a period of significant evolution with a clear vision to optimize the company to deliver great value to guests, associates, and shareholders. Zimmerman is in his own statement, expressed honor at having led the company through critical and transformative periods. He highlighted significant progress in our integration efforts and cost synergy goals since the merger, while also noting that there remains an immense opportunity to further optimize the portfolio and lock full value of the company's assets and intellectual property. Right there, look. Full value and company assets on intellectual properties. The video yesterday, we were talking about the peanuts. So look, I don't think they're getting rid of it, because if we see right here, Zimmerman's already talking about the full value. So, but hey, probability. So, analysis of Q2 2025 financial performance. You guys ready for this one? The announcement of Zimmerman's departure coincided directly with the release of Six Flags' second quarter financial result, which notably fell short of market expectations. Net revenue for the quarter totaled $930 million, missing Wall Street estimate of $1 billion. While this represented a 3.5 million increase compared to quarter 2 of 2024, it is important to note that 389 million of this increase was directly attributed to the legacy Six Flags operation integrated through the merger. Now, net loss. The company reported net loss 100 million in a quarter. This figure included a net loss of 126 million specifically tied to legacy Six Flags operation post-merger, a substantial deviation from analyst expectation and positive earnings report, or EPS. Now, attendance. Park attendance saw a decline of 9%, or 1.4 million visitors, reaching 14.2 million guests in quarter 2 of 2025. A more concerning trend was a 12% drop in attendance during the final 6 weeks of the quarter. Ouch. The overall increase in total attendance compared to Q2 2024 was primarily driven by an additional 1,238 operating days from the legacy Six Flags Parks post-merger, which offsets the 700,000 visits, or 8%, decrease in attendance at legacy Cedar Fair parks. Now, the EBITDA projection. Six Flags significantly reduces its full year 2025 adjusted EBITDA projection to a range of 860 million to 920 million. This represents a notable reduction from the initial projection of a 1.8 billion to a 1.12 billion. The following table summarizes the key financial performance metrics of Six Flags in Q2 2025 against the market estimates. So net revenue, you can see this is the actual performance, 930 million, net loss 100 million, park attendance 420 million, stock price change and negative 20%. You have year-to-date stock down 36%, adjusted EBITDA 86 here, Wall Street projected 1 billion, 2 billion profit. This is significant loss. So we're going to look at the impact at external headwinds. So management largely attributed the disappointing second quarter performance to external factors. This includes unfavorable weather across most of the company's key markets, encompassing prolonged periods of rain, extreme temperatures, and severe storms. Out of 2,042 planned operating days in Q2, 379 were impacted by weather. Whoa, that's a lot, dude. Leading to 49 parks being forced to close entirely. A critical aspect of this impact was that approximately 60% of these weather affected days occurred on typically high attended days, such as Fridays, Saturdays, and Sundays. Now, Zimmerman's characterized these early season headwinds as transient and pointed to a positive rebound in July. The first 4 weeks of Q3, where combined attendance increased by over 300,000 visits, or 4% year over year. The company also cited ongoing economic uncertainties and a shift of consumer behavior towards a value-conscious mindset, which resulted in a fewer impulse buys and delayed purchase of season passes and memberships. Now, merger integration challenges and synergies. Despite official statements emphasizing significant progress on our integration efforts and cost of synergy goals, the Q2 financial results, particularly the 126 million net loss specifically attributed to legacy Six Flags operations, suggest that the integration process has presented distinct operational and financial complexities. The company is actively pursuing further cost efficiencies, targeting an additional 70 million in synergy savings for 2025, and cost aiming of 9 million in year-over-year cost reductions for the second half of 2025. So right there explains what we are seeing, the layoffs of high managers at Knott's Berry Farm, the layoffs of of full-timers, the closings of certain theme parks. So this right here explains it. Underlying dynamics of the departure. Now, while CEO Richard Zimmerman publicly described the Q2 headwinds as transient and due to weather and macroeconomic factors, the severity of the financial underperformance, including the $100 million net loss, a sharp stock price declining of over 20%. Now, in April, the stock was like around 30. I checked this morning, the stock's around 25, dude. So that's a heavy decline from April, and a substantial downward revision of a full-year EBITDA guidance suggests that the issue may be more deeply rooted than temporary external shocks. The fact that 126 million of the net loss was specifically tied to legacy Six Flags operation added to the merger points to specific integration or operational difficulties within the combined entity. Now, rather than solely external market forces, the board decision to initiate CEO Richard, despite Zimmerman's public confidence in the strategy on the transient nature of the Q2 issues, indicate a potential divergence in perspective. This suggests that the board may view the challenges as more structural, and that a new leader is required to accelerate the pace and change of the synergy realization, particularly given the company's significant debt burden. You have to think too, when they merge, like they both took on each other's debt. That's pretty huge. Now, the timing of the departure therefore appears to be less more a pre-planned transition and more about accountability for the immediate financial underperformance in the post-merger environment. Furthermore, the Cedar Fair Six Flags merger has explicitly designed to generate significant cost savings and revenue uplift, leading to a stronger financial profile and reduced leverage. However, the post-merger reality reveals increased operating expenses of $523 million and interest expenses of $79 million due to higher debt levels. See, I told you, higher debt levels. You take on each other's debt, with net debt recorded at $4.88 billion, dude. The current net debt to adjusted EBITDA ratio of a 6.2x is significantly above the initial target of a sub 4x. This indicates that the anticipated financial benefit of the merger are either not materializing quickly enough to offset the increased cost and debt, or that the merger financial model underpinned the merger was overly optimistic. I think that's what that was. The company's recent announcement to explore a divestiture of non-core assets to accelerate deleveraging further underscores the urgency of the debt situation, a measure not prominently highlighted in the initial merger rationale. The failure to achieve the target leverage ratio and the need to consider asset sales point to significant financial strain and potential miscalculation in the merger's financial integration or execution. The incoming CEO will inherit a company under considerable financial pressure and a mandate to not just realize synergy, but potentially divest asset to improve financial health, which could impact the long-term strategic vision and portfolio composition of the combined entity. Now let's take a look at the implications of the leadership transition for Six Flags. Now, the departure of Richard Zimmerman and the search for a new CEO carry significant implications for Six Flags, affecting its market perception, strategic direction, and operational execution. Now, the market reaction to shareholder value impact. Now, the market reaction sharply to the news of Zimmerman's departure and the disappointing Q2 earnings. Six Flags shares plummeted by 20.7% on Wednesday, closing at $24.33. Baby, we got this baby on a discount right now. This represents a significant decline of $6.37 from the previous close and placed the stock far below its 52-week high of $49.77. Ouch, that's a deep decline. So this sharp drop contributed to a year-to-date decline of over 36%. The market's strong negative response reflects profound investor disappointment and heightened concerns regarding the company's ability to meet financial targets, effectively manage its substantial debt, and successfully integrate the merged operations. The following table provides an overview of key financial metrics and projections that highlight the company's current financial position and the challenge ahead. So we see the net debt $4.8 billion, net debt adjusted EBITDA. We got a 6.2 leverage right there, sub 4x. The adjusted EBITDA 8.6 to 9.10. The capital expenditures $470 million, 500. You got 2026 capital $400 million in a reduction. Target cost $900 million. Strategic continuity and future direction. The board and management have publicly affirmed their commitment to ensure a smooth transition and maintaining the company's strategic priorities. These priorities include driving meaningful long-term growth, increasing adjusted EBITDA, reducing net leverage, and successfully delivering on integration efforts to create shareholder value. Key strategic initiatives moving forward include synergy realization. The company remains focused on achieving the remaining cost synergy goals, with an additional $70 million target in 2025 and $9 million in a year-over-year cost reduction for the second half of 2025. So, the deleveraging. Six Flags is actively exploring the divestiture of non-core assets to accelerate the reduction of its high net debt. Capital allocation. Now, planned capital expenditures for 2025 are projected between $475 million and $500 million, with a reduction to $400 million planned for 2026. This indicates a continued, albeit disciplined, investment in park improvements and attractions. Operational challenges and guest experience considerations post-merger. While the merger was intended to enhance guest experiences by combining Cedar Fair's reputation for service with Six Flags' innovative ride designs and anecdotal evidence suggests significant operational challenges persist post-merger. Customer feedback highlights issues such as frequent ride breakdowns, inconsistent park policies, separate mobile applications for different parks, varying locker policies, and rules for carrying items, and perceived increases in food and beverage prices. There is a sentiment among some guests that the Six Flags mentality, often perceived as prioritizing profit over customer experience, is dominating the combined entity, leading to a less satisfying visit. I agree with that. If you agree with that, comment down below. Have you seen that change? I've seen that change. So the company itself noted a value-conscious mind among consumers, which impacted season pass sales and impulse buys, contributing to the attendance decline. The critical challenge for the new CEO will be to effectively balance aggressive cost-cutting and debt reduction with the imperative to invest and significantly improve the guest experience across all parks to drive sustained attendance and per capita spending. So strategic dilemmas and brand impact. Six Flags' strategic objectives include driving meaningful long-term growth and enhancing guest experience through continued investments. However, the company is simultaneously grappling with a high net debt to adjusted EBITDA ratio of a 6.2x and is actively exploring asset divestitures to accelerate deleveraging. While capital expenditures are planned for 2025, they are slated for reduction in 2026. This creates an inherent tension. Aggressive debt reduction, especially through the sales of assets, could potentially conflict with the long-term growth strategies that require substantial investments in new rides, attractions, and park infrastructures. The enhanced financial flexibility initially promised by the merger appears to be primarily directed towards addressing the debt burden rather than purely growth-oriented initiatives. The new CEO will face a critical strategic dilemma: how to effectively balance the immediate need for financial discipline and debt reduction for the long-term imperative of growth and guest experience enhancement. This will necessitate difficult decisions regarding capital allocation, which assets to divest, and their potential impact on the portfolio appeal, and how to manage pricing strategies without further alienating value-conscious consumers. The success of the growth strategy driven by innovation will be directly contingent with the new leader's ability to navigate this delicate balance. Now, furthermore, the merger was touted as a way to combine the strengths of both companies, specifically Cedar Fair's reputation for guest experience with Six Flags' innovative ride designs. However, direct consumer feedback reveals significant dissatisfaction, citing frequent ride breakdowns, inconsistent operational policies across the park, and perceived price increase. The sentiment that a Six Flags mentality, profit over customer experience, is prevailed as a direct criticism to the post-merger operational approach. This suggests that the integration process is negatively impacting the fundamental customer experience, potentially leading to a decline in the brand loyalty and repeat visitation. The reported drop in season pass sales and memberships further support this concern. If these issues are not swiftly and effectively addressed, the erosion of guest satisfaction could severely undermine future attendance and per capita spending, making it significantly harder for Six Flags to achieve its revenue targets deliverance. Deleverage. The incoming CEO will need to prioritize the comprehensive overhaul of operational consistency and a renewed focus on delivering high-quality, unified guest experience across all parks. This will require significant investment, not just in physical attractions, but also in staff training, technology, and a cultural shift towards customer centricity. This is a critical non-financial implication that directly threatens long-term financial health and market positioning. The search for a new CEO, succession plan, and desired profile. The search for Richard Zimmerman's successor is a critical undertaking for Six Flags, as the company seeks to appoint a leader capable of navigating its current challenges and capitalizing its future opportunities. So now to our conclusion. Outlook and key considerations for Six Flags' future. Now, Richard Zimmerman's departure for Six Flags make a pivotal movement for a newly merged amusement park giant, signaling the conclusion of one chapter and commencing of another. While presenting as a planned succession, the timing strongly suggests it is a direct response of the company's recent financial underperformance of the persistent complexities of post-merger integration. The incoming CEO will inherit a multifaceted and demanding mandate. This includes the immediate challenge of stabilizing financial results amidst ongoing macroeconomic headwinds and internal operational inconsistencies. Crucially, they must accelerate the realization of the remaining merger synergies and address the substantial debt load that continues to weigh on the company's financial flexibilities. Beyond financials, the new leader must unify and significantly enhance the guest experience across Six Flags' vast and diverse park portfolio, which has shown signs of strain post-merger. Now, the market sharp and negative reaction to the Q2 results of the leadership change underscores the high stakes involved. The ultimate success of Six Flags' future will hinge on the new leader's ability to not only drive rigorous financial discipline and operational excellence, but also to effectively re-engage customer and consistently deliver on the promise of a truly integrated and superior entertainment offering. Now, the strategic choice made in the upcoming months regarding asset optimization, investment priorities, and operational inconsistencies will be a defining factor that determine the trajectory of Six Flags for years to come. And that's going to be your report on the departure of Richard Zimmerman, stepping down as CEO of Six Flags at the end of this year. Go ahead and comment down below. Let me know what you think about these in-depth videos, and what do you think about the departure of Richard Zimmerman, and what's your take on it? Do you think it's going to be a good thing, bad thing for Six Flags? I hope somebody steps in, because I'm obviously rooting for fun. I hope they could pick up Knott's Berry Farm and stuff, but go ahead and comment down below. I'd like to know. Well, that's going to be it for this video. I will catch you next video. Deuces.